Welcome to the BOGART Effect, a wealthy wisdom podcast. The following BOGART Effect podcast is intended for general information purposes only. The information discussed is no substitute for personalized investment advice from BOGART or another investment professional. Please see important disclosure information at the end of the presentation.
Hello, my name is James Bogart, CEO and founder of Bogart Wealth and host of the BOGART Effect, a wealthy wisdom podcast. Thank you so much for tuning into our podcast in 2025. We've had so many great conversations and discussions through the year, and we're excited to bring you more in the new year. I want to take a second to highlight some of our favorite moments and especially relevant topics that we've covered through the year. Episode links are available for you to go back and listen to the full episodes. Thanks again for an excellent 2025 and happy holidays to you all. See you in the new year. Real estate is part of a diversified portfolio with Patrick Marcinko. Let's transition a little bit and let's talk about like true bona fide rental properties. And this can be different shapes and flavors. We've got clients with all walks of life here. It could be commercial, it could be residential. So it could be you buy a home and you let's just say it's a residential home. You turn it into a rental property. Let's talk a little bit about opportunities and risks associated with that.
Great question. Well, investing in real estate is an incredibly powerful tool. Commercial, residential, a lot of it, I would say we have to measure what I would call your return on hassle and quantifying what that ends up being. And that's really where rental properties come into play. The primary source is the rental income itself. You know, there's some tax benefits we'll talk about in a little bit in terms of depreciation, but really understanding, okay, what is the market that I can get on rent? And what are things like vacancy? Do we have a building or a place that people are going to want to come to your place and they're going to be chomping at the bit to get there? So you know when one tenant leaves, you can immediately put someone else in. Or are you going to have a period of a couple months? All of these things need to be factored in to size up, is this investment worth the hassle? Because one of the things that I think gets talked about in financial media a ton is, well, rental incomes are passive. Rental incomes, you just buy it, someone pays you, you make money. And we both know that that's very far from the truth.
It's not always that easy.
And even for the folks that they pay someone to be the property manager, you still own the property, you still have to be involved. And that's where I come up with this return on hassle.
Creating your retirement paycheck with Brian Windsor.
How do you approach this? You mentioned the financial plan. Well, what does the financial plan tell us, right? To start building these blocks. Well, first of all, it's going to tell us what's your cash flow needs, right? How much money am I going to need for my investment portfolio to pay the bills? And
some individuals, we take it the other way too, right? Like, what do you need to spend? Let's start there. And sometimes it's a very hard reality check sometimes. And then sometimes it's the other way, which is we need you to spend more. But there are instances where it's, hey, that's just not a realistic spending number relative to the amount of assets you have. And again, that all intertwines with the plan.
And it's time frame. You know, how far are you away from your retirement or how far are you away from needing that paycheck, and what age are you going to be? So how far are you away? What age are you going to be at that time? What are your expenses? What's the weight of the percentages that you're going to need from, the portfolio or other assets? All kind of go into it. And what's your tax situation too? So there's just a lot thrown into the blender, if you will, to really understand your situation's different than your next door neighbor. Your situation's different than your parents. And knowing that.
And it might even be different than your colleague who works at the same company that might even be making the same amount of money as you, right? I mean, it's everyone's plan is unique and is bespoke in different nuances. And I think that's why it's so important to kind of bring these issues to the forefront, candidly, as early as we possibly can, especially if there's a scenario where we need to be doing some course correcting. I always joke. Estate planning in 2025 with Nell Cordick. So I think it'd be helpful, though, let's describe each document. Like, what is the purpose of each document? I know I mentioned will, power of attorney, medical directives, and trusts, but what are each? So what is a will?
Absolutely. So we first start off, the will, the power of attorney, and the medical directive are the three absolutes. Everyone must have all three of those. So the will in its simplest form actually dictates exactly where you want your assets to go upon your passing. And it includes your personal property as well as your real property. So it encompasses both. Your power of attorney basically is in place for while you are still living and when someone may need to take over for you to handle your affairs. So your power of attorney dies with you, just as an FYI. And the power of attorney is really there to be invoked for accounts that are in your individual name. They are basically accounts that are probably your individual name that have a beneficiary attached. And then when you do your medical directive, the purpose of the medical directive is again to appoint someone while you are still living to make medical decisions on your behalf when you are not able to speak for yourself.
Yes, sound mind.
And it can occur short term or it can occur end of life decisions. So you may have a situation where you're needing to make a decision because you were in a car accident and they need to make a decision to have surgery, and then you fully recover and are able to take care of your affairs again. But it could also be an end of life decision where they're making decisions on your final care.
And I think the theme that I would emphasize with this is it's important to give clarity and let's just say intention around what you really want to have happen.
Absolutely.
There's nothing worse. Let's use that example. Net unrealized appreciation with Sidney Rutledge. So when I kind of set the stage and I talk about NUA as a tax strategy, I think it's important to note, when we take money out of a 401k, we pay ordinary income. So we're subject to ordinary income rates. When we take money out for NUA, we pay ordinary income on the cost basis. So what we bought those shares for, to then move them out over into a non-qualified account to then be able to sell them at capital gains rates. So really the benefit here is the difference between ordinary income rates and long-term capital gains rates. So Sidney, why don't you talk a little bit about who qualifies for NUA and how does this even become a conversation where it's something that can add value to a household?
Sure, absolutely. So you mentioned a great point about those low cost basis shares being the most advantageous when it comes to NUA. So who would benefit the most from the NUA conversation and it as a tax planning item for their household is somebody who does have a decent amount of employer stock within their pre-tax 401k plan, specifically those employees that have maybe been buying shares or company match can be part of it as well. Those shares that are at a very low cost basis. The higher cost basis shares, as long as the market value that the shares are currently trading at, anything below that is advantageous from an NUA perspective. But specifically, those employees that have been buying shares for a long time and have potentially some really low cost basis shares within that employer plan.
Yeah, and just to kind of put some numbers to this, we work a lot with companies, with employees of companies that have employer stock in their 401k. But let's say, for example, you have shares in your 401k that were bought for $15 per share, and the stock is now trading for $105. Well, that means that we have a pretty significant amount of capital appreciation, $90 worth per share of capital appreciation on each of those shares. So, tax planning with Troy O'Callahan. What is the best way for our clients to stay up to date on tax law changes?
That's very challenging. And you probably saw with this one big, beautiful bill.
That's a great name.
There were lots of changes to the bills as they were being debated. And as the House passed it or the Senate passed it and they hadn't passed a final bill, there are things that were in those bills that did not survive. And so if you kept track of it, you might be confused about what actually happened. And then there's also a bit of spin that the media has and the politicians have about different components as they try to sell this bill to America. But if you want really good resources, what I would do is the IRS has two. Surprisingly, they have two different resources. One they call the newsroom, and that's where you're going to see tax law changes, some fact sheets that summarize things. You can also get on their email subscription if you want emails from the IRS. And then beyond that, I would just go to good sources like Bloomberg, Reuters, Wall Street Journal. I will warn you about reading the actual bills because I tried. This bill modifies an existing bill. And so when you read the bill, it will say, strike this word from the original and replace it with this word. So you don't get the meat of the bill in that revision. You'd actually have to go piece maybe a couple bills together, and it just takes a long time to do it. It's confusing.
Well, and said another way, I think some of it's still subject to interpretation, and I'm sure we're going to see private letter rulings on a couple of the nuances of the One Big Beautiful Bill. We've already seen letter rulings on interpretation for the IRS as well. So more to come, I guess.
Absolutely.
But most of my understanding correctly is the most of the One Big Beautiful Bill, the meatier things don't go into effect until next year. Is that correct?
That's correct.
So we have some clarity for the rest of this year, but a lot of what we're looking at is 2026 stuff.
Correct.
2025 year-end planning with Morgan Beth.
Tax loss harvesting. We do it throughout the year. I would say most do it year end. So it's definitely a good year end kind of reminder if you don't have someone professionally doing it for you. And that is, hey, if I have something that is at a loss right now, I'm going to sell it, harvest the loss, take on the loss, and then buy something else. You can't buy the exact same investment, but buy something else for 31 days. And then those losses can either offset capital gains that you already have, or they can go against ordinary income. Up to $3,000.
Up to $3,000. Yeah. Yep. Emphasize on the 31 days because there's what's called a wash sale rule. Yep. So if you sell something for a loss and then buy it back within that 31-day period of time, it disallows that loss on your taxes. By the way, that includes a dividend. So if a dividend pays in that window, so just be careful of that. And being deliberate about realizing losses as best you possibly can, simply because we want to use those to offset against gains. 2025 is turning out to be another year where we don't have a lot of losses.
No, but that's also why we do it throughout year end. There were a lot of clients that we did harvest losses in April.
Yep.
Right? So when the market was down, and no, it's not we're intentionally looking to have a loss in the portfolio, but we're going to have something, right, that goes down. And so it's just taking advantage of it while still keeping the money invested. I kind of describe
those losses as like a credit account, right, where you can use to offset against future gains.
Yep. They just keep carrying forward.
Exactly. Which, to your point, it's not that we're doing it intentionally to have losses. We don't want to materialize losses. But at the end of the day, it's another one of these optimizations where you harvest a loss, you can buy something else. It could be a proxy, right? Yep. Like, for example, in our value portfolios, we'll sell individual stocks that have losses and then we'll buy an ETF. It's not the same thing. It's not like kind. Yep. So it allows us to have, the equal level of allocation, but we're not actually owning that specific position. We wait the 31 days, we buy them back. Beautiful.
We've saved just in tax money.
And potentially have a chit going forward. Right. I mean, to offset future gains, which hopefully we have lots and lots and lots of those.
Exactly.
The previous presentation by Bogart Wealth was intended for general information purposes only. No portion of the presentation serves as the receipt of or as a substitute for personalized investment advice from Bogart Wealth or any other investment professional of your choosing. Different types of investments involve varying degrees of risk, and it should not be assumed that future performance of any specific investment or investment strategy or any other non-investment related or planning services, discussion, or content will be profitable, be suitable for your portfolio or individual situation, or prove successful. Neither Bogart Wealth's investment advisor registration status nor any amount of prior experience or success should be construed that a certain level of results or satisfaction will be achieved if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Bogart Wealth is neither a law firm nor accounting firm, and no portion of its services shall be construed as legal or accounting advice. No portion of the podcast content should be construed by a client or prospective client as a guarantee that he or she will experience a certain level of results if Bogart Wealth is engaged or continues to be engaged to provide investment advisory services. Copies of Bogart Wealth's current written disclosure brochure and Form CRS discussing our advisory services and fees are available upon request or at www.bogartwealth.com.
The tax partner featured in this podcast is part of a team of accountants and tax professionals associated with the accounting firm of Troy O'Callahan CPA. Employees of Troy O'Callahan CPA render accounting and tax services for Bogart Wealth pursuant to a written agreement. Troy O'Callahan CPA and Bogart Wealth are not affiliated in any other way and are not under common control. No client of Bogart Wealth is required to use Troy O'Callahan CPA for accounting or tax services, but if Bogart Wealth provides you with or agrees to provide you with accounting or tax services, you will receive services from Troy O'Callahan CPA. Service provider fee rates, in addition to investment advisory fee rates, may apply. Please contact Bogart Wealth for more information on tax preparation and return service. The use of any CPA firm is no guarantee of results or outcomes.